Happy Monday morning, smarthelping.com here. We are going to get through this assisted living facility financial model today, or more of it. Welcome. Hopefully, everyone had a great weekend. Uh, let's send our link out to Twitter, do a sound check. Let's send our link out to Twitter. Looks good here. And don't forget, guys, the model I'm doing now will be included in the real estate bundle on smarthelping.com. In this section, it'll also be included in the industry-specific financial models tab in this category. And then again, you could get all the templates on smarthelping.com for $9.99. All right. So getting into this, I'm trying to get a lot done today. I want to get the executive summary done, get uh, all the cap table, Capex stuff in here, the financial statement, import logic. So we've made a lot of progress last week in the model. So basically, you can model out acquiring or developing an assisted living facility. So we have all our development in like you put hard and soft costs here, or if it's just acquisition, you'd put that in here. There's a bunch of different sections to handle all kinds of different stuff. There's even a land only section. You've also revenue assumptions. You've got per bed type, base price, then tiers of care prices. Now you could use this probably for a lot of different things, not just assisted living. Probably use it for a nursing home because it's got all the staffing logic for that. Probably even a hospital. You could use it for honestly any kind of multifamily real estate, probably mixed use real estate as well, with the way all these assumptions are laid out. This particularly is built for an assisted living facility though. But again, the logic here is pretty universal. So you've got up to 5 room types, the room count of each type, and then with each type here, you also have tier 1 through 6 tiers of care. So like this is one bed type. Here's the price for the different 6 tiers of care for those 6 different, or for that bed type. And then here's um, the prices for the 6 different tiers of care at this bed type, in this bed type, and so on. So you define the count here. You can define the starting occupancy, the monthly increase in occupancy, stabilized occupancy by individual tier. So it's pretty flexible and robust in the revenue assumptions. We did staffing. Here you can see you've got all the different in-house positions to start month there, count, salary, payroll tax and benefits, yearly increase in salaries. You've also got outsourced stuff. Uh, so here's more insourced, RNs, LPNs, STNA caregivers, and you've got outsourced stuff like therapy teams, other doctors, audiologists, pediatrists, dentists, all that kind of thing, and their fees. So a lot of granulation on the staff. You've also got just general operating expenses here. Startup costs. You can also choose how much you're financing this, the facility acquisition cost for and development cost for. You can potentially have a development loan, then a regular loan that it rolls into, and then potentially refi. Or you don't have to have a refi. You don't even have to use any of this debt. You could also hit no here on cash sources, and it would just go all to equity. All right, so that's where we are now. Got this monthly detail, and we're going to continue on here. So what I need to do, a couple things. Let's bring up the startup cost and capex up above the cash flow before financing area because that needs to affect that total. So this and this are cash out items that will affect any amount you're potentially going to finance. These two are fine here. Okay, and capex. So we have our development acquisition costs right at the top, but there's also going to be a capex schedule for like equipment, things like that. So we haven't added that yet. That'll be to be added. So let's do this plus this, and these will come through as a negative, so we can just add them. And then since they're going to be included in that, we can remove the calculation from here. So in cash flow after debt service is taking this cash flow before financing, adding any proceeds, including the net effect of any debt service. Now, hold on a second. What happened to this? Why is this? So this already included these two up here. I'm trying to figure out why that. Okay, I think that covered taxes, extra proceeds, cash flow after debt service, and then these two. No, okay, so this is double counting because cash flow after debt service already includes these two. So all we have to do here is remove 66 and 7. So we're not double counting those two. Okay, now that's correct. You always got to be careful about double counting in these financial models. Let me just double check here one more time. So we got cash flow after debt service, which includes cash flow before financing, which includes Ebitda, then these two things. So you've got that, proceeds that affected debt service, and then taxes, extra proceeds. Okay, so that should be everything that will exist in the cash flow. We just got to fill these two in later. Annual detail, let's update that as well. So let's see, 266 and 67. Or just go to 269. Okay, really we just need to add these two rows. So that's there. Let's bring in the sum ifs for this. And then add these two. We can delete these two. Oh wait, these two. Oh, no. Taxes are down here. Startup costs will delete. Capex will delete. Perfect. Okay, so we're all matched up there. Okay, so monthly detail is good. Uh, Distributions. So we got to bring in our capex schedule or the cap table to do this, but we have the project level on a monthly basis in that discounted cash flow analysis. Um, so that's fine. Okay, so this is done. I believe. Oh, executive summary. So we definitely want that. And we're going to pull, so we're going to pull all these other statements from, let's see, uh, we could pull it from the vending machine model. So executive summary, copy, paste here, get rid of our grid lines, update the references. Oh, this is actually going to be a 10-year model. So I do not want to use the vending machine for the other stuff because I need a 10-year model to do that. But this is fine to use it for because It's just referencing the annual detail. So here you'll, on the executive summary, it'll just show a high level look at revenue, expenses, EBITDA, and then other cash flow items. Here we could put, what's a good metric? Probably total active rooms, maybe. Which we should have. Oh, no, we don't have that. We just have occupancy. No, that's fine. We don't necessarily need a top level item. So revenue is here. There's no cost of goods sold. It's a more of a, you know, real estate thing. You know, you're not buying and selling things for a profit. There's no year zero. All of the IRR and discounted cash flow analysis, everything's going to happen on a monthly level for this model. We don't need this. Okay, now we do have, so we're going to separate out staffing costs and then general. We can just call this SG&A, selling general and administrative costs. So staffing is going to be, let's see, housekeeping, outsourced, and then, oh wait, what did I miss? 157. Oh yeah, that's all of that. Outsourced staff. Okay, so that includes all that, and then here we don't have any R&D. There will be SG&A, which is just going to be all these other overheads. All right, total expenses. Okay, so depreciation expense we will have in here, but it is not built yet. Let's fill these out. So we could definitely do taxes will be here. Capex. Debt service. Now we'll do principal and interest for refi, the regular one. Startup costs. Exit proceeds. Loan proceeds. Now this loan proceeds, we'll do proceeds from the draw. Oh, we forgot interest only payments on this. So we started at 277.78. We need to add interest only payments, and that needs to come through as a negative. Let's make sure it does. So if I do non-accrual, where's my interest only payments at? So that's coming in here. Ah, this needs to be a sum if, so glad I caught that. And I'm going a little fast today, but I really trying to get progress here. Okay, so there's that. Okay. Loan proceeds. Now loan proceeds. So we got the initial loan proceeds plus we'll have repayment, which it looks like we're going to have to update that formula as well. Penalty fees plus proceeds from the refi in that, and then the repayment there. And we're going to call this net loan proceeds repayment. Now, I believe we have to update this annual formula. Repayment of initial loan should be here. So monthly 279. What happened with this? Oh. So that's yes. Am I not doing a refi? No, there's a refi. Repayment is in R. Index R. Oh, include terminal value needs to be switched to on for that to flow. Now let's think about that. If the initial loan could be repaid and you could do refi but still not include the exit. How do we do this? This is a little complicated. Repayment of initial loan, but we want to say, well, what happens if you don't want to include terminal value, but you do have a refi? We could do an if and. Trying to think what's the easiest, most elegant way to do this one. Well, we could go right onto here. No, that needs to stay like that. Well, I guess, does it make sense to have an option to have a refi but not have an exit is the question. I believe it does. All right, so we're going to have to do another formula here. We're going to have to say if and if this equals no, but your debt logic refi equals yes, then you want to pull the value because that means you're doing a refi even though you're not doing, potentially not doing an exit. So that equals no, and that equals yes. And do this, otherwise do the regular string. Now, okay, so now we have a value in here, even though it says no terminal value. Now this one will not do, and there is no terminal value, so the refi will not have a repayment. We have to add this logic to the prepayment penalty fees as well, though. So put this in front of here. And then, oh, whoops. We need to match Q. Wait, no. This is indexing R, Q. This needs to be Q. Alrighty, so there's that amount. Now, you should be able, so we know it works if you refi but no exit. Let's make sure if this is a yes. Does it work still? Yep, so it just flows like normal. Okay, then that should be all the variations here. All right, so now in the annual we have that, repay. Here's the refi proceeds. Now on an annual basis, you still have more debt service than that, which is fine here. And the refi is just based on a, what do we base it on? A Ebitda multiple and then LTV percentage. Okay. So if we look on a monthly level, it should show up here. Let's look on a monthly. Well, actually, it's not a huge difference. The debt service is actually higher. Let's say the LTV is like 70%. Okay, that's more like it. Now you can see the bump hit there. Where is it? There it is, 136. Okay, because that's going to be a big factor in the internal rate of return calculation. And if there's hurdles, we're going to do waterfall stuff like that. So timing is definitely going to matter. Alrighty. Well, so we do have a negative here. Oh, because there's no exit value, there's just the repayment happening so far. Okay, so this is fine. Got the debt working good. Debt logic is always the hardest. Here. Okay, come on, Excel, don't freeze on me now. Come on, I know you can do it. Come on, computer. Got a $4,000 computer here, and it's freezing up on just Excel and OBS. Well, this is really freezing. Okay, are we good? Looks like it. Let me save real quick. All right. So I believe we have all our monthly and annual detail. Executive summary should have everything. Selling vending machines is not relevant. We might put something here though. Let's just clear this for now. Inventory purchase is not relevant. All right, now in theory, this number should match if we minus from our annual cash flow. And, oh, we're off by 10 million. So clearly we're missing some things. Probably, first of all, let's check Ebitda. It's at 19,827. Okay, so that matches, so it's just all this other stuff. So let's go to cash flow. Let's just redo the whole calculation. So we got Ebitda. Then this will be coming through as a negative. That'll be coming through as a negative. This, that. Okay, I believe that's everything. Yep, so what are we missing here? 10,850,000. Uh, well, is any of these amounts? No. It's a pretty smooth number, actually. Let's read. So this is net loan proceeds repayment. Let's make sure this is right. So net proceeds repayment. So we have proceeds, repayment, penalty, proceeds, repayment, penalty. Let's try this again. Oh, that is everything for that one. There's no exit. Let's just go start. Okay, so cash flow for the first period. We're How are we so far? Oh, okay. Acquisition, development. So that's definitely there's the amount. Okay, so we're good there. Let's just add this. And now we match. Okay, so we know our executive summary is good. Distributions, we can do a check down here as well. So the sum of the cash flow here should equal the ending cash position here. Perfect. So that's good. So all these are all linked up with the same numbers. So that's a good start. All right. Oh, we do have some visuals here I can update. This is a check. All right. Let's see. So this is total revenue. Put that in there. And then Ebitda. This operational cash flow. All right, looking good. And then we don't need these values. I don't need that either. All right, I believe that 369. That looks good. Let's go run this thing to the end of the last month of the last year just so it looks clean. Make sure everything still matches. Good, all the checks are good. Now again, these numbers are just arbitrary. It's based on the assumptions I put in here, which are just I built in a way where I can check all the logic. All right, well, we're moving along here. Executive summary's done. This will need updated. Let me just put the yellow here. Update this. We'll do that after we get the distributions tab done. I believe I can just drag this over, but I'm going to have to input the percentages based on the cap table. Also, we're going to do, so there's going to be one summary where it just has, okay, here's what you're getting from inside investors, here's what you're getting from operator investors, and then it's going to show a percentage that each get of the profits, and then do a distribution in this kind of cash flow for each party based on that. But there's also going to be more advanced Irr Hurdle Waterfall. It's going to be essentially a completely separate summary that has nothing to do with this. But it just is going to give you the option to have and it's not going to be in the financial statements either. Um, but it will give the option to show, if you do those kind of structures, what the cash flow should look like. Alrighty. Let's just give these their nice blue text. Um, well, okay, we're half an hour in. We got all this ready to go. Let's do our import of everything else. So we'll start this right here. We'll have cap table, Capex, terminal value. We got startup costs, debt. This is new, so that'll be a different logic string. And then we have our financial statement. So we'll have 1, 2, 3, 4, 5, 6. So remember, we spent the last 7 months implementing financial statements into all the models. Now we got to do this continually going forward with the new models that are being built. So income statement, monthly, annual, balance sheet, monthly, balance sheet annual, cash flow statement, monthly, and annual. Now this is going to be a little tricky because I have a Capex schedule that we're going to put in, but I also have, there's going to be depreciable items from the purchase of the um, business and or the development of the land and all that stuff. There's going to be depreciation on like the construction. So all these costs. So I have to figure out how to implement that into the other schedules, which is going to be fun. Because these will all go into fixed assets. I'm trying to think about, so okay, let's start. So we need a 10-year model to pull from. And what's a good one? I'm also going to do taxes a little bit different on here when I do the exit. I'm only going to do taxes for that in that month. The rest of the taxes for each year will be spread out based on operational income for the year. What is a good 10-year model? I can't remember. Ooh, no, ATM's manufacturing. Let me look at this one. 10-year model, okay. We don't have inventory, but that's fine. We don't have any of these cost of goods sold. We do have all this OpEx. This will work. What's the CapEx look? The CapEx is no, we don't want that. We don't need that many items. I mean, I could just hide the other rows and not reference them. Technically, and just maybe give it. No, we're not going to try to force it. Let's see. What's another 10-year? The rental. No, this isn't. This is a 5-year. I need a good 10-year model. Oh, the gym fitness. No, all these 10-year models that I have are all with crazy Capex schedules. Like they have a whole bunch of stuff. Let me see if I have any SaaS stuff with a 10-year. Ooh, this might work. Product as a service. Yep, okay, that's looking good so far. It's 10-year. Oh, it's only a 5-year. All right, let's see. Lending as a service. Let's look here. I think this is a 10-year model. Okay, it is 10 years. Does it have anything weird in it? Capex is looking good. I think I can use this one. Now we're also going to have some complicated things with the debt. It's going to be more granular, or just different than what I usually have. So we'll have to have some manual touch on that, but that's okay. All right. Well, this part's a little bit off. I mean, that's okay. The main thing, I mean, I'll just have to re-reference some of these things. All right, let's use this one. So here we go. Capex schedule. Put in here. Cap table. What else? Terminal value. Okay. We've got that. I'm just going to call this debt schedule, even though we're not going to be referencing any of the stuff on the same position. It'll be all different. Right. Let's get the income statement in here. Okay. Balance sheet. Man, there's going to be so much work to get this thing looking good on here, or working right. It's going to be really fun if you like puzzles. It's going to be really hard for me, but we'll get through it. Cash flow statement. All right, now I just need to make sure I've got a reference for every reference in there so I can do a find and replace. I believe I have it all. So let's go ahead and replace. We don't need this extra tab. We're gonna go replace everything that says, oh wait, I need to get it. Everything that says lending as a service V3 XLS. Now we're gonna hope this works. the whole workbook, replace all. Nice. Okay, so now everything I just imported is all linked up. We don't need this anymore. Well, that's good. Let's format here, and we'll just start it on the income statement. Whoops. All right, all these need to be 15 with. We'll figure out about the terminal value in a bit. All right. I'm going to try and build everything as is. We're going to have to add all logic for this, for the depreciation for that. Well, let's get in here. So income statement first. Let's do the annual as well, formatting. Whoops. Okay. So we have one revenue stream, which is room rent income. That's the only income there is. And that is going to be here. Oh wait, no, there is ancillary revenue, I forgot. So we have the revenue from each room type. One, two, three, four, five. And then we also have other ancillary income. Okay. Drag all of this over. And we have our income, no cost of goods sold. Costs, we have staffing costs, including payroll tax, all that. And then we have SG&A. So staffing, we're gonna go, actually, oh no, we can't use the executive summary. All right, so it's this plus outsourced staff. And then here is, oh wait, we have three items actually: staffing, in-house staff, outsourced staff, and then other SG&A. Okay. So 202. Let me make sure I didn't. Yeah, I double counted there. So 157, 202, and then other overhead. Now my Ebitda should match the monthly. Also, let's just update the annual to match this. Okay, so Ebitda, we are at 21 at 181, 498. 21, 181, is that what I said? 181, 498, 74, which rounds to 499, which matches. Okay, so we're good on that. Depreciation is fine for the Capex portion here. However, this is going to be just another Capex. It's not going to be for a building because we have that elsewhere. So you'll probably end up zeroing this out and using these for equipment, or you could use this for equipment too, but you have to manually do the resale value. Okay, well, I guess it's time to do depreciation logic for this. So let's think about this. If you buy the building, you can't obviously expense the building um, as an expense. Now there is some things like certain bonus depreciation. There's different things you'd have to talk with your accountant about. I'm not really worried about that for this purpose, but I do want to make it so that you can define the percentage of each of these sections that can be depreciated and the useful life. So let's do a new tab here. Now, if it's not depreciated, let me think. Like the land will not be if you're separating out the land or if you're buying land. Whatever that value is cannot be depreciated. And okay, so let's see, how do I structure this? All right, let's just go. So we've got the months going across. We've got, let's see, how am I going to do this? Because these potentially can happen over time. Oh, this is going to be tricky. I mean, I guess I could do, so total cost basis. And we have type 1 here. Other costs, other costs, other costs, land. So we know the cost basis. The problem is, like we can say, okay, we spent a total of 10 million in acquisition. We spent for development 750, but it happened over time. I think we have to do a formula to find the latest month that an expense went in, and that's when depreciation starts. Because I believe you can't depreciate it until you actually start using it. So we'll have to do that. All right, other costs here and here, here, and then finally the land. All right, so there's your cost basis. We have our months going across. I might need years as well. . Let's go out 10 years. Okay. Not 125, 15. Now I have a cost basis. I have time. I need to know, I'm not going to start the depreciation here until start month of depreciation. We also want to put in here useful life. Now, if you have, you can override this. If you want to say, okay, I'm going to depreciate this amount and this amount each year, you could just go in here and put it in, drop it in here. You'll break the formula, but it will still run through the model and flow to the right financial statement areas just fine. Useful life, let's just call it 30 for all these. I'm just trying to make it programmable, but you can override it in the section here. Now our cost basis is going to go into total assets. We're going to try and do this all for one row. All in one row. The gross effect of everything. Okay, start with the depreciation for each of these. Now, this one will probably be 0, but I'll build it in the logic in case, for whatever reason, some of this can be depreciated. You could just put it in here, but it's going to be default left 0. It still has a cost basis, so then we'll put it in here just so you can see. Let's say, you know, we bought land for 250,000 or 2.5 million, and that should flow through everywhere. Yep. And then we're financing 75% of acquisition development costs. Just try to scoot this over a little bit. All right. So useful life, let's find the date. Let's just try and do this. So let's say index. Our goal is to return the value of the month when the last, no, that's not going to work. We'll have to do a schedule here. So we'll have to go if this is greater than 0, then 1, otherwise 0. We also have to then say if D26 is greater than 0, then D26 plus 1. And that is how we count time. So we know for the first section, that's the timing, and we'll just take the month of the biggest well, no, we're still going to have to get tricky on that. Actually, we could just do, we don't need to count. We could just say if the value is greater than 0 than 1. And then we could do that for all these. So this is, no, shoot, we need to count. Oh. All right, let's try another way. So let's do total here. Let's do this plus month 2. Okay. Total here. This plus month 2 on that. Total here. Actually, I'll just drag this over a little bit easier to do it that way. Fourth one. I think I can do it with the cumulative amount, and when it stops growing, well, we're just gonna see. Hold on. Whoops. Okay, D. Okay. So we have this accumulation of purchases or costs coming in over time. We want to know, let's just do a couple more of these just to make sure the logic is going to work. Okay, so we have some costs happening here. We want to know what month is each section considered complete and being used. Now that I actually think about it, we don't need any of this. We could just go in here and go, okay, as soon as revenue starts, this is when we're operating, this is when depreciations can start. And you'd have to make sure that this month coincides with your development schedule. So we don't need any of this actually. All right, all we do is say if, watch, this is so simple. We just say if this month is greater than or equal to operating start month, then take the total cost basis divided by the amount of years, and then the monthly amount divided by 12. Simple as that. And if it is, oh yeah, then we go 0. If it's not greater than or equal to. And just so you can see it, let's give everything like a 7-year useful life, just so you can see the total depreciation that happens. And we can also check the logic in that way. Okay. Oh, we have to add an end month, which is going to be this times 12. Or actually, it'd be e-date. And everything starts on this month, comma, and then useful life times 12. Okay. So we say if this is greater than that, 0, Okay. Oh, we gotta lock Control C12 as well. Now this assumes that whatever cost basis you have is fully you reach that cost basis by the time the building starts, which in theory you can't really open the building up unless you're done with development or you've bought everything, so that makes sense. That's logical. What's going on, guys? Hope everyone's having a good Monday. We're just grinding here trying to get this model going. Okay, so let's just make sure our total cost base, total amount depreciated equals that. 13,534. Okay, so we're off by 1 month, it looks like. So this has to be here, -1. Now let's try. We're going to treat all this as one line item in the fixed asset schedule as well. Well, let me think. Hold on. 13,375. Okay, so that matches. So we've got our logic working. Let's put this useful life back up to like 30. Uh, Now the asset value, we can say this one we're doing 0. This is land, so it's going to default to 0, no depreciation for that. Okay, so that just zeroes out. That's perfect. We don't need any of this. All right, and again, you could manually hard code all this if you wanted to. It doesn't have to follow this straight line depreciation method. That's just what's being programmed. So now if I go to the income statement, we add depreciation, acquisition, development. We simply reference the one row right there, and that is a negative value. So there, oh no, actually we're bringing it in as a positive value here. All right, so drag this all the way across. Now, like I said, we're going to change some things up with how the taxes are calculated on fixed assets and all that, but we can't really get into it until we finish making everything else line up. And remember, financial statements are really like a puzzle. They really are. All right, this can be just drug crossed. Now, we have our depreciation happening. We do have to stop the depreciation. So if our date is greater than the end month, so let's say July for just arbitrary purposes, you can see this stuff stops. We got to put that onto here though as well. I can't tell you how many times that's caused problems where when I've been integrating something and I had to manually do the depreciation, I forgot to put that in, and then the balance sheet would have matched because it'd be doing depreciation for the last some amount of months, and it would cause an error. Okay, so that's looking good. This is still off by quite a bit. 23 million. I wonder, I guess we could set, okay, so on the exit, if we are including terminal value, we're basing it on trailing 12-month EBITDA times the multiple, which I agree with. So that's fine. So let me make sure income statement 28. Yep, that's the EBITDA. So trailing 12-month EBITDA is going to be the basis for valuation. times a multiple. Okay. So taxes. So see how this tax rate, this is going to assume from the annual tab. Wait, some income statement 59. Wait a second. I'm summing monthly 59 for the income taxes here. Here I'm summing 58. I was confused. So 58 is the basis, so taxable income. So here we only want, so that's pulling from this. I don't want to include the extraordinary income or any of this net gain or loss on sale of assets to show up in here right now. So I'm going to remove, this is just an extra reference here, as well as 55. So this is the first major update, is these taxes are going to be separated from the exit taxes. And that's just if you want to see like post-tax cash flow, because it's going to be taxed somehow on the exit, but we're going to separate that out. I think that's the right way to do it. All right, so let's see, taxable income now is just EBITDA minus interest and interest. Let's not forget the interest calculation. Hold on before we forget that. So here, let's see. Interest is actually going to be, we're going to actually call this interest and fees. And we're going to reference interest here. Well, interest only payments. Then we've got interest here, interest here. We've got prepay penalty fees, which I want to do as well. All right, so that should be everything. And that's a prepay penalty. Actually, let's do 74. We'll do the prepay penalties on the net exit amount. So this is 74. We don't need 80 or 87. So these last two. So here's our interest cost. Not principal and interest, just interest. Why is that stopping in January 2026? I need to be adding 285. I should just be adding 74, 78, 74, 78, 85. Oh, come on, Excel, don't freeze on me. Okay. $74, $78 plus that plus this. Oops, and that's got to be in C, not AD. Okay, there we go. There's the refi interest, and then it should stop there. Perfect. All right, so that wasn't too difficult. Now this extraordinary income from the sale of business, we're taking the total terminal value. That's okay. And then the gain here, so how do we separate this out? Let's do 2 rows here. Let's call this taxes on extraordinary income, taxes on fixed asset sales. So here I can simply say, well, this is the extraordinary income. This is essentially all profit. And this number we want to subtract from or add it. Let me see how it's coming through over here. We want to take these prepay penalty fees out of that. Yeah, so we can add that. And I guess that's it. Because that would go against profits. I gotta figure out where to put you know what? For the interest, prepay fees. No, we could keep this as interest on the other selling general administrative. I think I could put that into there. So let's add 257. Let's add both of these into there instead. Prepay penalty fees. There. Okay, it needs to be subtracted in. Wait, what? Minus. Hold on. What the heck? Plus a negative. Now that should do it. No, what the heck? Okay, negative. Oh, 0. I must have. Let's see, C 287. 287. I also want 280. So plus negative 280 plus negative 287. Oop. So that should net come through as a positive, bigger amount. Okay, there we go. And same with this. 310 goes to 406. Because that's about 95,000 versus 190,000. Okay. So that is going to include prepay penalty fees. I'll just put that in the instruction video when I go through that. Now, since I added it there, I don't need to add it here, or else I'd be double counting the fee. All right, so all we did, we putting that prepay fee up there, just reducing taxable income on the monthly, but that's fine, no big deal. Um, so I have my taxes, net gain or loss from sale of assets. Now this is where things get really, really tricky because I've got two sets of fixed assets now, not just one. So let's see. We almost have to separate out. So here you can think of this. Oh, this is going to get so complicated. We have our depreciation happening of these assets. We could do the net value. We could say if this equals 0, then 0. Otherwise, take the total value here minus the total depreciated. Okay, and that's going to give you your cost basis over time for what's considered a gain or a loss. Now, let me make sure this is working. If you go full depreciated, let's say the useful life here was only 7 years for all these. This should be, wait, no, that's not right. Oh yeah, 2.5 million. So it's saying everything's depreciated except for the land, which makes sense here. So this is our cost basis. Okay, so that's this row. Now what I want to say is when I exit, if it includes, if the exit value includes the transfer of all these, the building and all these assets, because you're selling those as well as extraordinary income. There's all, when you sell stuff, categorization, all that's kind of crazy. It's pretty complex. So I'm just trying to give a general um, a general view of what's happening. Now I believe we're going to have to define. So let's say there's no value assigned to these at exit. So you've got this exit value of 5.4 million. You're saying 5.1 is going to extraordinary income, 270 is going to these other Capex items on the other schedule, which is here, which these could be other equipment items and other things. And then 500,000 from the sale of row 1 Capex, whatever that might be. Let's just get really clear here what this is. So this logic is fine. It's separating out these based on, what's going to extraordinary income versus fixed asset gain or sale, which is fine. But now you have that. You also have as a separate transaction the sale of these, your building essentially, and possibly whatever cost basis that has. If the cost basis is 2.5 million and everything is going to these items, and and this is your total value that you're getting, then in theory, your loss, if you're fully depreciated on everything, your loss is essentially the land value, because this is saying, well, then you're giving the land away for free, and you had 2.5 million, so you're taking a 2.5 million dollar loss. If these were not depreciated, say the useful life is 30 years here, now Well, we're gonna have to do a thing here to end this if this is greater than the end month, then 0. You'll see how all this ties together. And I'm doing this now because I know when I get to the balance sheet and everything, it's gonna need to know this. So this is the most complex part. Okay, so here we now are saying the value at exit is 30,000. No, I'm sorry, 10 million. You've only depreciated of the 13 million value, you've only depreciated 3 million, which is this 3,262. So your basis is 10 million. If all of again, if all you're getting on this exit, if you're even doing an exit, is this amount, that's for the business and for these other fixed assets. That means you're again taking a loss here. So this would go against your taxable income as a negative value. Now on this, we don't have a negative. There's no negative income tax here. If it's just there's no gain, then there's no tax. That's fine. There's more complicated stuff again with your tax return. It gets way more complicated, but I'm just trying to again put some stuff together for a general financial simulation. So here, so all these items are going to go into this. This will never be negative, but it could be offset if you have a loss on these things on this section because you didn't have enough to apply to it, or you counted this Ebitda value 5.4 million only went to these things. So let's think about this. So if this is value, so let's say 10 million after the depreciation, and here's your cost. We need to assign proceeds from sale of items above. And this is just a manually hard-coded value. We can put right here. Let's say in this case it was 11 million. And we're already defining that specifically for these fixed assets, so we can say on the exit, so if this equals this, well, and this equals yes, because you're not, if it's no, if you're not including terminal value, then all this doesn't matter, but I'm making it so you can if you want to include terminal value. Then take this total proceed minus whatever the cost basis is. Otherwise 0. Oop. Okay, and you're only doing this on the exit month only. So let's drag this over. So your profit in this case, 887 is taxable. You're getting 11 million in proceeds. Your basis is 10 million based on your depreciation. So profit 887, that's taxable. That would go in that, and we'll also say this is always going to be a value of maximum of this or 0. Because if it's negative, we're just not going to count it as anything as far as gain or loss goes. Well, technically, so let's say this was like 8 million. So this goes to 0, you get 8 million. Technically, you had a loss there, which should offset this to be a negative. and then this is a number you just make as a maximum of 0 or the value. But if for whatever reason this number was greater than the loss you did have here, you should be able to offset. So let's actually remove this maximum from this one. So that can come through potentially. And so we go back to here, and on this we say, so if we have all this logic. This plus whatever happened here. So now we're at a negative, and then we just say this is always going to be a maximum of this or 0. And the total proceeds will come through still. So this 10 million, or sorry, this 8 million will still hit your cash flow statement, but you had a loss on it since your cost basis was higher than what you are allocating towards this amount. So that wipes out the gain from the other side and lowers your tax liability. Now we still have this extraordinary income amount, which is taxable. We only want this amount to come through on the monthly. So what we do when we go to income tax is we say, yep, take all this plus, because right now this annual amount does not include this 5 million taxable. So you can see you've got the value coming in here, but there's no income tax for this 5 million that's happening. So we want it there, but on the monthly, I just don't want it to be spread over the last 12 months. I want it to be in the month. So what I'm doing here, let's see, sum if that times that, plus, oh wait, DM56. So that's taking that amount plus this times our rate here. Now also, we have an issue, so this is multiplying DM56, which is this amount, times global control C26, so that's nothing. We've got to update the reference there. 26 is no, it's got to be the capital gains rate. Okay, and that's it. So now in that month, yes, there's some more taxes, but again, we have the 5 million coming in. I just didn't want to spread it out through the whole last year. And now that should, in theory, come through on the income statement, right? Yep. Okay. Now we still have an issue of off by 24 million. I'm to figure out what happened there, but this logic was important to get right. Now let's say, again, let's say your cost or your amount is 11 million. So we have a little bit of a gain on the exit. So we go over here, we see there's a gain, that amount is being taxed, plus the amount on here. Okay, and the taxable income here is a little bit lower because we are including the prepayment fees as a reduction in basically as SG&A expense on the loan if there is a loan. All right, so far this should make sense. I actually don't need these extra rows here. on either of these. Now what I do need to figure out is where am I off here? So this is 37,445. This is 13. Let's just look at the first 12 months. It's 1,109,000. Here you're at 1,184,000. So we have a clear issue. Taxable income was 3,262. That's right. So it's a tax rate issue, it looks like. 2,153. No, wait, that's the same. Let's look at depreciation. 173. That's the same. Let's look at, ooh, it might be the interest calc maybe. Wait, let's look at Ebitda 2456. Okay, Ebitda. Other SG&A we don't have. So that's the amount. There we go. So now we're balanced. Now the income statement, monthly and annual match based on all that stuff we just did. So I feel like, yeah, that's really good progress. I'm happy we got that done. I think it's necessary. It works. This all makes sense to me. We will have to add, we now have now if we don't, let's look at if we don't include terminal value. This is 0. That zeroes out. However, when we reference this all zeroes out, but this is going to have to be referenced and that has to be 0. So let me go, and that's going to be a monthly detail item that we have to add. Those are fine. I'll have to add that in. So on the exit proceeds, let's just do this right now while we're in here. So I want to do equals cash flow statement. And again, this is going to take a bit to finish, but it's going to be sale proceeds plus sale of depreciable items plus, and then we have to do if, only if this equals yes, then also add in let's see, I don't have this anywhere else, so I have to do if this equals that, then we want to do, and if control C equals CA equals yes, pull, don't freeze on me now, come on. This then a terminal value, or the value assigned to the fixed assets, if I can get there. Okay. Okay, do you want to work now, please? I knew it was going to be an issue. Oh, come on. Like it's seeing that I'm in the statement here. I've had more issues than I can remember with this stupid Excel lately in this formula freezing up when I reference other pages. Oh, this is a bad one. Come on, please. I feel good about the model. I thought it was going to be harder. This actually, it looks like this should be pretty smooth. Um, Going through the financial statements, and if I can finish the financial statements today or get close, then all we really will have to be doing tomorrow is some visualizations, and I mean we should be pretty good, and then just the final sanity checks. Yeah, this is a bad one. Hopefully I saved recently. Oh, come on. Well, anybody have any questions while I'm waiting on this thing? Feel free. Oh, this is so annoying. Come on, Excel. This didn't happen for, I don't know, when did this start happening? I felt like if I had to reference something on another tab, the Excel would just freeze. I think it's been going on off and on for over a year because I was working on a different a client's project, and it started doing it, and I thought it was because of them. I don't think so. It's just an issue with Excel. I wonder if it's because I'm in the insiders program maybe with the Office 365, and it's just like a bug that just comes up here and there. Yeah, this is really bad. This is really bad. Come on. All right, I'm gonna have to shut it down and pray that that save, worked. Please. All right, let's try and bring it back up. Okay, somehow I landed. I'm on the distributions tab. I don't know. And see, the issue is when you get into that lock and it locks you up between tabs, you might be clicking stuff and it's recording what you're doing in other cells, and you might break something that you didn't even know you were on, which is scary because then you don't have any idea what might have happened. So, I mean, this looks like it's okay. It looks like it's okay here. Okay, back to exit proceeds, right? So let's do if and this equals the end month and this equals yes, then just give me this value, otherwise 0. And that's all I want. And then you just add the other exit proceeds that will be in the cash flow statement here. Okay, that's all I want. And then so if we hit yes, if we hit yes on this, that's showing up there with all the rest. So 16,902,000 should be this total plus this. Okay, good. So that's fine. That's coming in there. That's coming into here. We have it in. Now hold on. How is this equaling annual detail? Oh, I didn't add it to the annual detail. Yeah, because that's going to be off. Let's get both of these in there. Okay, so the annual matches monthly, but now executive summary. Okay, now this has got it. Why? So here, look at this blank cell. This is probably something I erased out when it was frozen. So let's redrag that over. All right, so this is checked off, good to go. Monthly and annuals checked off. Distributions is checked off. Now cash flow statement, I'll have to add that other item in there into here, which we can actually, let's see, how do I want to do this? I've already got the lot diff and statement in here, so I could do that, plus the sum of Capex, plus this. Okay, yeah, I'm feeling really good about this model, actually. This is looking good. And I'm excited. I'm going to try and get through all these financial statements if I can today. Let's just get it all wrapped up. All right, so freeze here. Oh, I do have to do a waterfall. That's going to be a separate thing, but I don't see any issues. It's going to be a monthly Irr Hurdle Waterfall. I'm going to attach to this. All right. 16902, that looks like our number. These should be fine. Oh, and we have all the debt stuff to do. Oh, there's a bit to do still. Okay, so we're just working along. So that's in income statement, monthly and annual is good to go. The monthly detail now has our logic for that. We also need to add in taxes here, which is going to be right here. Okay, like that. Capex. So the second Capex item. Oh, come on, Excel. Every time I go to reference another tab in this formula, it just wants to freeze up. It wants to be in the cash flow monthly tab. Hope everyone's having a great Monday as we plug along. Holy cow, it's coming up on a 2-hour stream. That's cool. Yep, this is right. Yep, see, cash flow is trying to. Let's try it again. Okay, here we go. Cash flow month. Nope, it doesn't want to do it. At least it's not completely froze up. I'll just manually do it. So I want the cash flow row 17. So I'm just going to pull it right from here. So there's that. Okay, and that's working. Now, I did have a cool waterfall on the debt that I wanted to put in the executive summary. That's from the mixed use model, which is where the first time I used this kind of debt flow. You can see here how I did the interest only part, interest initial loan and refinance, all kind of nice. So I might try and do something like that towards the end of the build. All right, let's just make sure. Okay, that's got our other Capex. Now hold on, does this have, We need to put in drop downs for this. All right. Looks good. Am I pulling it all? It's 432.5. Yep. Okay, good. So we got there. That still checks out. No need for a reminder anymore on that. So we can potentially finance startup costs and other Capex, as well as development and acquisition costs. And remember, we can define the month revenue starts and as well as the when the development acquisition costs happen and all these different schedules, which is kind of cool. All right. And here's that schedule. You could determine how much is going to be financed, what percentage is going into the development loan, if it accrues interest or not. If yes, you don't have any payments until the end, then you start with a regular P&I at some point. This will probably match up with your launch month, which you can define here. Okay, where am I? Cash flow. So debt. This is definitely going to be a complicated part. We have to, let's think. So borrowing of long-term debt. I think we can just reference the monthly detail, I hope, without a circular reference error. Let's just see. And we're going to assume the interest-only loan is part of this, so we just go proceeds from here, plus, and then we repay it. That gets repaid, then we get well, this just rolls into a loan, there's no proceeds. And then we have the refi proceeds. Now the prepayment penalty fees are already in OPEX, so we don't need to worry about that. So let's look up borrowing of debt. That. Okay. Principal repayments would be the debt schedule. Now this is where it's definitely going to be different. This is just going to actually be equal to let's think, this rolls into this at the balance, but principal repayments happen here, here, and here, as well as the refi part. So here we start on the P&I of the second loan. There's a refi happening here, but also borrowing more. And then the end, there's a repayment of that, but you've got extra proceeds. Okay. So that looks fine. I believe we've got all this. So interest is already in the income statement. Proceeds we just did. Repayment, and then repayment we just did. All right, so that's great. Now you see how this is it's so much like a puzzle. So now we need to figure out our minimum cash required, which should just be the minimum here. Or if you look at distributions, it's going to be the total. Let's actually do it like this. this is actually easier because I'm not doing a complicated waterfall. This I'm just doing if it's a positive monthly cash flow, it's a cash return. If it's a negative, it's a cash um, investment or distribute or yeah, contribution requirement. So the net of those, 10 million is equal to that. And I can adjust this thing. This can actually be C to DR. And those would equal this once I'm done. Okay, so what we say here is in theory, the total cash that's going to be required is 12.5 million from investors. Now, or equity from somebody. If we were to say 100% of this is financed, you see that's going to go down. So now we go, where was I? Now it's 13 million. And that's probably because we have a lot of burn from debt service. Yeah. So in this case, let's just try to do something that makes relative sense so it's not so extreme. But right now it's basically saying, our operational cash flow is 568. Our debt service is 115, so we have 453 here. Taxes, wait, we have positive cash flow for these. Oh, but as we go on here, okay. So we're paying taxes, cash flow for France 299, 200, 184 left after debt service. Now our taxes here, 242,000. That seems high. Let's look at our formula for taxes real quick. In year 2, it's saying 4.4 million in taxable income. Let's see. That's after the depreciation. Let's go to the monthly for year 2. So, am I missing anything, first of all? 242,000. 4.4 million taxable income. Let's see, am I missing anything? Oh. 4.4. We've got that depreciation in there, Ebitda, and interest. 3.7 million in Ebitda. Let's go over here. Year 2. Okay, now this doesn't make sense. So yeah, so something's off here on the distributions because my actual cash flow is almost positive every period, and the total negatives. Let's see. Does this equal the same 9,575,000? Let's go back actually as well and put this to 75%. So we're saying 10 million, now it's 10,849,000 for net. Let me look at this. No, this is 25 million. I'm off by 15 million. So what are we missing here? This is 10,849,000. And the last month should be 21,677. Let's look at that. No, this is only 10 million. Okay. For year 10, we have 10,711,000. Here we have 21 million. Now, how is that possible? We're just adding 4.7, 2 million in taxes. That makes sense. Am I double counting something in OPEX possibly? Yeah, because something's not right here. So let's look at the cash flow monthly, and let's look at the monthly detail, because these should actually match. Let's go cash flow for the period. Okay, yeah, so obviously there's something wrong here. So this is negative 3.3, this is positive 9 million. We're missing, oh, the development. Okay, yeah, all this is not, so, okay, so Capex, we're going to also count, let's see, how do we do this? These are all, yeah, we're gonna do all this. So it's all of those amounts and then minus all of these, development acquisition. So that's definitely going to give us a little bit of a different number now. So we're still at 6,174. What am I at on my monthly? 6. And then these are still out. Let's look at what this is out by. So this is out by that amount, actually, exactly. Also, we have taxes here, but is that really, let's see, 12 months, $2 million in taxes. How is that? And my receipts and costs are like 2.4. So this seems high, first of all. Yeah, we're gonna have to figure this out. So there's a couple things. First of all, we're missing a whole bunch of stuff here because these need to be matched. Hope everyone's having a great Monday. It's almost noon, and I am just in the thick of it here. Let's see, when's my next meeting? 12:30. Okay, well, all right, let's see here. Let's see. So we're out. This is positive 6 million. And my monthly is negative 6.5. So something is not being added here. Okay. Okay. So this Capex is double counting because it's already including this here. So that's one thing. So let's fix that right now. So this is going to be, let's see. This does not need to take into account 14 anymore. And also these don't need to be formatted like that. Okay, so that's the first thing that I think we had. That's a big issue. Okay. That. Now let's look at the monthly cash flow. Okay, now we're just out by the startup costs, and now we're actually looking like it makes sense. So startup costs, it should be in the income statement. Oh, we didn't put it in here. Startup costs, right there, and put it in the annual. Now, our monthly cash flow should match 3,381, then 184, 3,381, 184. Okay, perfect. So that's good. These are all matched up. I wanted to do so with the taxes here. We're saying that the first year we actually had a profit of taxable income of 2.4. Now, are we missing a sign here? Because taxable income should be equal to Ebitda 28 minus, interest is coming through as a negative here. So that needs to be plus. Yep. Okay, so that's a pretty big difference there. Okay. Here, so this is a negative, and we're summing. Okay, so that's fine. We don't need to change the sign here because it's not directly referencing it. All right, a little bit better now. Taxable income is 1.8, income tax is 1.2. That still is way too high, so something is still wrong here. Let's keep on looking. So taxable income is 28 plus 31 minus that. Okay. So taxes. So we're doing. Technically, this is not an active month if this is less than our launch month of operations, which is here. And that should affect this as well. Okay, now they've gone up. How's that possible? The income taxes are a million higher than taxable income. Obviously, okay, hold on. So taxable income seems right. This is definitely wrong. So let's look at the logic. If C5 is greater than control, then 0. Otherwise, sum if annual 58, which is taxable income. If 58 is greater than 0, and 4 is equal to the year times global. Okay, there it is. So times global control C25. That's the wrong number. It should be, I believe, 30. Or let's see, what's the regular income tax one? 30. There's your issue. I was multiplying by 25, which what in the world was 25? Is multiplied by 66%. Obviously, that's not right. So there's this. Okay. Now, I've got to figure out, we don't want taxes to populate within a month before we start operations. but we still need the full tax amount too. Like this, so we made 1.8. How? 2.3. Let me just do this here. We had 2.3 plus that minus this minus this. Okay, so there's the issue here as well. Probably with the interest. So 31 should be a plus. So sign change, also 32 is nothing. Okay. And I'm assuming our net income also is messed up. So we don't need this. And then 31 is a plus. This is why I say sometimes it's harder to work with an existing template than making your new one from scratch because you have stuff like this. Normally all my formatting is the same though, so imposition is the same, but here this model is a little bit different, and so this is what we get. All right. Well, we're getting closer to being somewhat proper here. Let's look at the annual taxable income, income taxes. These are still like 50% of our taxable income. How is that possible? Let's see. Oh, it's dividing. It's dividing this 1, 2, 3 by 5 months and assuming that's the amount for the whole year. These need to be 0 then. So if this equals 0, then 0. No taxable income on those months. And now I believe it's correct. So that 80,000 should only be populating for those active months because we only have 4 months active in the period. Now the rest of this should be the same. Yep, no change. That's fine. Okay, good. Now it's more like it. So taxes here divided by that, 22%, which is what our tax rate is entered in. Also, we don't have those negative cash flows there. So let's look at the cash flow statement. This probably will make a lot more sense now. So we just have startup costs, nothing, and then we have operating positive cash flow here. These are our equity requirements. Then we start to go positive. Also, let's look at the monthly. So the cash flow is just essentially the Capex, but the amount the equity is required to contribute, and then you got positive here. Now if we go to our distributions, net of 23,558,000. This is 24,878, so still off by a little, by something, because those should match at the moment. 24,878. This is 23,558. Wait, this is off. Let's see. So 23,558. 13. What are we off here? Oh, did we not update the annual? Yep, I think we're still double counting this. Yeah, we are. Okay, so this needs to be zeroed out. This is why we have all these sanity checks. This literally saves us. Okay, so that's better now. So 23,558 is the number. That's the number there. Cash flow is 24. So we go again. Let's pull in our monthly cash flow and see what the difference is. Okay, so here we can see it's happening in year 8. What's 132.15? Well, what number is lower? This number is higher, so we're missing an amount somewhere. And all of this work now is going to make the balance sheet easier to do once everything here matches. So we got to do this. Let's see, is this out the whole time? Yeah. Are these taxes? 121. Let me go all the way to the end and see. Yeah. Yeah. Well, actually, no, it's something else because this is off by 10.9 million. So there's something going on here. Let's see. Principal repayments. We haven't done this row yet, but it's okay. That sale depreciable assets. This 10,934,000. What could that be? And what are these numbers? 130, 129, 129. There's nothing here. Oh, this doesn't match anymore either. We double counting. Yep, so this is being double counted. So I guess we don't need this row because we're counted there. Okay, good. That's back to checking to 0. But this is really the complicated part. Why are we out? What's double this? 160, 160, and we're out by 130 here. So, well, what could it be? Principal repayments. I mean, operating activities, we've got 709 operating expenses, interest. Oh, geez. Oh, the interest is the sign change on the interest is really causing a ruckus. All right, so let's 0 out that minus, drag this over. Yep, now it matches. There's still an issue with this exit month because that was off by a lot. 11 million. Okay, so and we know what the 11 million is. So are we double counting the 11 million on, because it's here and here, so we know 16.9 is the right amount. What are we doing here on the monthly? Yeah, this is all double counted. So since we did the logic on the cash flow month, we no longer need to do this whole big thing here. We don't need this. Since we put all the logic on the cash flow statement instead. Okay, now 12,558,000. 12,558,000. Oh my goodness, it's a miracle. These match. These all match. Okay, now what we can do, so that was a fun little 20 minutes there. Now we can do our max negative amount is actually no, we simply go here to Capex, or no, cap table and say our required, no, we go here and put it, is going to be the total negative amounts here. That's how much equity we need. Now, if we have that much equity, we will literally break even at zero cash balance. Not break even like for the returns, but we will have enough cash to always have a positive cash balance. So that goes into here. Then the cap table, oh, it's a different position. That goes to there. I'll have to update the references on this thing. Okay, that goes there. And then we go to the cash flow statement and we have sale company stock, that amount. Now, here's where I do want to make a change actually. So sale of company stock is going to be actually any negative cash flow. So if the monthly detail is less than 0, then this is an equity requirement. And then that's a cumulative amount, so we add it up over time. Oh, no, this is cash flow statement. We just do the amount. So this is the equity contributed over time based on any negative cash flows that happen during the whole life of the template, the forecast. Now, this will cause this to be off because our monthly detail is not going to show a cash balance after equity received. It's just going to show the project cash flow before any equity. Okay, so we have that. You can see if we put on the debt schedule, if this were like 100% and we're not paying any taxes up front, our the equity requirement, where is it? We actually don't have any for a while. There's just some, so on the refi, there's an issue with the principal. Well, the repayment of the first loan's worth more than the refi, but that's an extreme case because we funded 100% through debt. So you've got some equity requirement there, and then you've got some burn happening here, probably because of the debt as well as more OPEX coming online. Okay. And this total, you can see the total sale company stock is 3901. It matches the total cash outlays of 3901. Now here there's no IRR because we actually don't have any negative cash flows for a while. This is a rare case. Now 999 times out of 100, you're going to be doing some percentage, like probably 75%, or it depends on the bank. But you're not going to be able to just finance 100% of that. So then you got to come up with some of the equity to do the acquisition and development and cover any burn. Okay, so there's this. You can see the equity, any negative cash flows. Now note, there's also contributions happening here. Like in these later times, you've got negative months, but you've also got positive months as well. If we look at the annual effect on the executive summary, yeah, the debt service is just high here relative to the Ebitda. So you probably would restructure based on these assumptions. I would say you've got too much debt. Maybe start with either you need lower interest rates or fund less of it with debt, maybe 60%. Maybe pay some of this interest up front. Maybe you need a lower interest rate here. But still, I mean, the IR is 32.6%, so that's good. You're making $13 million net, so you put in 6.8, you're getting all that back plus 13 million over the life of the model. Yeah, see that here the debt service is actually more than the operating activities. So that's a negative discounted cash or debt service coverage, which we see here. It's below 1. And if we do another decimal, let's do 2 decimals on this. You can see a couple of these are below 1, which means your business is not generating enough in cash flow to cover the debt. We've also got some taxes going on here. And our refi is, you know, let's say the Ebitda multiple is maybe 3 on this. LTV is 80%, 5% interest. Okay, now you're positive here. So this is, why the model is built, so you can play with these kinds of things and see what's going to happen. All right, well, now that we got all the cash flowing good, I mean, I don't know if I want to look at the balance sheet today or not. I've only got about 15 minutes till my next meeting. Got a lot done today, though. This is going to make tomorrow very smooth. And that's good because I don't want to drag this out for the whole week. Let's see, let's format this real quick and see what's going on with our balance sheet. This will be the hardest thing to balance out and make it dynamic. So, yeah, we're out here. So this is going to have to change. So outside investors versus insiders, we're going to have to go off of, so total equity times what percentage? Actually, I need to put that in. Hold on. So let's say in total, we know we're getting this much equity. Investment funding is going to be from the cap table this much. So this is that minus that. Now we have to do over here the percentage of the total. And then this will apply to our equity contribution amount in the balance sheet. And let's change this up a bit. Let's say owners are coming up with a little bit more. Let's say 500,000, 250,000. Okay, so it's 90-10, but these people are operating it, so that's why they're getting more good percentage of the company. So 90.2. So now we go to the balance sheet and we say, okay, any money that's required, which we know from here, this amount times, and then outside investors is that. Now this is a positive number. So we just keep doing this. Plus a previous number. And then for this one, we do the same calc here, but now we go multiplied by A24. And this is the same row 19. Oh, 26 times negative 19. 24, 26. This needs to be 26. And then, oh, I changed the wrong number. Times 24 on here. Okay. Here, plus this. So this should be the total equity, and then also we want to say if our date is greater than, I'm starting the second month on purpose here, is greater than end month or exit, then 0. Okay, now the total equity before we exit should match what our total contributions are. So 7674 should match this. 7674 it does, which should also match this. And the cap table amount, yes. And then 6924 versus 750. Perfect. Okay, so those numbers make sense. We're still off by quite a bit. So here, I'm gonna have to stop because I got other stuff to do today. But tomorrow we'll get into this. We gotta add um, development, land acquisition to this. I'll just put this in yellow so I don't forget. So that's where we are, adding that to here. Also update depreciation and debt. That's definitely going to be a little bit different. And then other than that, after those three things are done, and we'll be ready to start checking things off. Yeah, this is going to be, yeah, this right now is just nothing. This doesn't mean anything. We got to update that. Cash. Yeah, we got a lot of stuff to do here still, but I've got through a lot of the mud of what I've been thinking about all weekend, so that's great. Like we're going good here. So tomorrow I'm gonna try and finish it up, and we'll see. This is a long stream, 2.5 hours. I'll see you guys tomorrow. Have a good one. Don't forget, check out smarthelping.com. For more, you can buy all the finished models I've ever built for $9.99. The one I'm doing now on assisted living facility is going to be part of the real estate bundle. It's also going to be an industry-specific bundle. Uh, it'll be a one-time fee of $75, or you can buy everything in bulk. Tons of value there. All right. Happy Monday. See